Our special coverage of the Fed Decides here on Bloomberg continues right now on the close as team surveillance right now passes the baton along to Scarlet Fu, along to Katie Greifeld, and along to myself, Romaine Bostick, as we take you to the closing bell and beyond. Guys, 13 FOMC meetings we've had, of course, going back to March of last year, 11 rate hikes coming out of those 13. We're back to pause, but Jay Powell wants you to believe that they're going to hike again this year.
Yeah, and it's made clear in the statement of economic projections, right, where they see one more rate hike this year. They also revised up GDP forecasts for this year while seeing lower inflation as well. What I found really interesting was Jay Powell's pushback that the SEP is not a plan. This is simply the median of all the individual forecasts that have been compiled. Yeah. And he made clear that forecasts are highly uncertain. For anyone who's out there trying to craft a narrative based on all those projections, he's saying, you know what, this is hard work, and this is the best that we can come up with.
No
right
one
now
would ever craft a narrative.
No. But it's a reminder that monetary policy is an art, not a science.
Well, let's go. Sure, some people believe that. You sound like an economist. But let's just go through real quickly some of those numbers that we did get out of those projections. Basically, you're leaving the benchmark rate where it is, but making it clear in that dot plot. 12 of the 19 officials right now favoring another rate hike for this year. And they're saying they're going to raise their projections for 2024 as well as 2025. A revision higher on GDP expectations for this year and next, and a revision lower for the unemployment rate, which I thought was interesting, not only for this year, but for the next 2 years out.
And you marry those numbers into what we heard from the man himself in the press conference. This moment really stuck out to me when asked if a soft landing. Was it when he pulled out that iPad? That was pretty good. I do have a lot of questions about that.
It was the best advertising Apple's had in years.
You didn't see the stock pop, but in response to a question whether a soft landing, whether it's safe to call that the baseline, he said that he wouldn't call a soft landing the baseline expectation. Yes, it's their primary objective. It's possible, but not the baseline. But then back to Scarlett's point, you take a look at those revised numbers. It kind of looks like they're projecting a soft landing.
But don't read too much into that.
I'm trying not to.
Yeah, I think, though, he wants the market, I guess, to at least have enough sense of urgency that, another hike is going to come, but at the same time, have enough confidence that the economy isn't going to fall off the cliff. It was interesting to see the market reaction, of course. We talk about stocks at one point, just a few minutes ago, we're at session lows, and, of course, you had that 2-year yield, which everyone's going to be talking about, camped out at the highest level since '06.
Yeah, moving up, up, at least in the aftermath. It came back down a little bit, but still remains higher, 5.135%. That's the highest in a couple years.
Let's walk you through some of the cross-asset price action. Abigail Doolittle standing by. Abigail.
Well, Romaine, this Fed meeting certainly not a snooze fest, and from a cross-asset class standpoint, lots and lots of movement. And I would say that if we were to title the overall meeting higher for longer, take a look at the 2-year yield that you were just talking about. So when the decision came out and the sense that they will be raising at least one more time this year, plus the dot plot being raised for the subsequent years, hotter economic projections, up, then down, and now higher, and at the highest level since 2006, essentially signaling that the market is taking the Fed seriously on the idea that they are going to be staying higher for longer. A similar message for the Bloomberg Dollar Index. Rising rates will support the Bloomberg Dollar Index. And from a technical standpoint and a longer-term standpoint, the Bloomberg Dollar Index is breaking out, suggesting that the rates rising that we're seeing today, that this trend, not just today, over the last several weeks, months, and even years, over the last 2 years, is going to continue. Now, you're talking about stocks. This is interesting because the NASDAQ 100 overnight really treading water, basically into the meeting even treading water, but at this point down 0.8%. So stock investors also taking seriously the message that more money coming out of the system and that valuation, especially for big tech like this, could be made more precarious. If we go to other indexes, we are going to see stocks, I think, basically at the lows. The S&P 500 down 0.5% now, heading toward its third down week in a row. Small cap also down 0.4%, I think below its 200-day moving average. The SOX down 1%, and then that New York FANG index down 1.3%. A hawkish pause, higher for longer. One of those characterizations does seem to be appropriate, or maybe both, for this meeting.
The market reacting right now. Of course, the Fed back in July did hike rates, putting them back on pause today. Jay Powell making it clear that the decision to hold today is based on how far we've come. Take a listen to some of the other comments that he just made at that press conference.
Real interest rates now are well above mainstream estimates of the neutral policy rate, but we are mindful of the inherent uncertainties in precisely gauging the stance of policy. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective.
The chairman of the Federal Reserve speaking just a little while ago, a little bit earlier today. Bloomberg opinion columnist Bill Dudley said that there were going to be 5 key things that he was watching in today's Fed forecast, including will there be another rate hike this year? What's the outlook for unemployment? How low can unemployment go without stoking inflation? And what's the neutral Fed's funds rate? And when will rates start coming down? Now that the forecasts are out, let's bring in Bill Dudley, joining us right now, former New York Fed president, former vice chair as well, and over at Princeton University Senator for Economic Policy Studies. And let's start with the neutral rate, because this seemed to be one part of the press conference where he seemed to struggle a little bit in articulating exactly how they're going to assess when they think they've finally arrived at that rate.
I think the message of the meeting was basically 2 things. Number one, soft landing is more likely because you can see the unemployment rate only has to rise now to 4.1% to get the job done. Back in June, it had to rise to 4.5%. And number 2, economy stronger than expected, and therefore, while policy is probably not as tight as we think it is. So there have been a little bit of upward movement in people's estimates of the long-term federal funds rate in this summary of economic projections, first in June and again this month. So what basically the Fed is concluding is maybe monetary policy is not quite as tight as we think it is, but they're also very, very happy about how the labor market's unfolding. They basically think a soft landing is more likely. Quite a bit more likely. I'm a little surprised by the market reaction. I think the market reaction should be bond yields up because the Fed's going to be tighter for longer. Stock price is sort of mixed. Higher bond yields weighing on stock prices, but more chance of a soft landing. That's a good thing for stock prices. So I'm a little confused by the market reaction.
That's interesting. You mentioned the stock market reaction because one point you make in your column today is that keeping a rate hike in the forecast, you write, has the tactical benefit of restraining markets, which might otherwise decide that we're done and generate an unwanted easing in financial conditions. Bill, you've been in the room before during these discussions. How mindful are policymakers of the market's tendencies to immediately make assumptions off of each clue that's dropped?
The market's always searching for what the Fed's going to do from anything, from the statement, from press conferences, from speeches. So I do think keeping one rate hike in the forecast does sort of, keep the market from running away from the Fed. But as Chair Powell mentioned in his press conference, it probably doesn't really matter that much at the end of the day whether they do that rate hike or not. It's not like the economy is going to turn around dramatically if the Fed does a quarter point more or a quarter point less. I think the way he's trying to explain why they might do another quarter is to make themselves more confident that they're going to achieve their objective. So let's imagine the data is sort of ambiguous as we go through the next couple of months. So if it's ambiguous and the Fed's not really sure that they're actually going to achieve their objective in a timely way with the current level of rates, you do one more rate hike to try to increase your level of confidence. So at this point, it's not really about, do they have to go another quarter or not? It's really more about would going another quarter make them more confident that they're going to have the outcome that they seek.
And Bill, beyond whether or not they're going to hike one more time or not, I think it was interesting that they actually took a few cuts out of next year's forecast. When you think about the expectations for 2024, what should we read into that? Is that the soft landing perhaps coming into fruition, or should we take that as maybe inflation is going to continue to be a problem here?
Well, they didn't really change the inflation trajectory very much. So I think the way I view taking the rate cuts out is the fact that the economy is just stronger than expected. If the economy has more momentum, I don't need to support the economy as much with rate cuts. So I think that's really the message, because the inflation forecast didn't really change in a meaningful way.
We're in conversation right now with Bill Dudley, Bloomberg opinion columnist, and of course a former chair of the New York Fed. I want to bring into this conversation our very own Michael McKee, our chief international and economics correspondent here at Bloomberg, who actually wants to participate in this conversation. Mike, take it away.
Yeah. Well, let me tell you what I take out of this press conference, and then I want to ask Bill what he thinks, because he's the central banker and he has a much better idea than I do of what they're talking about in the room. But it seems to me that there's a bit of an internal inconsistency in their forecasts, in that they've more than doubled their growth forecast. They significantly lowered their unemployment forecast, and yet inflation is supposed to come down. So are they saying at this point that the stronger growth we've seen is not inflationary? And my takeaway from that would be they're done, but they're leaving that extra rate increase in before the end of the year as an insurance policy. And the same sort of thing holding true for the cuts they took out last year. If the economy were to produce inflation, then they have something in there that they can point to the markets and say, we did this. Bill, is that kind of the way people should take this?
I think that's the way people should take it. I mean, I think it's very interesting that before they had the unemployment rate going up to 4.5%, now the unemployment rate only has to go up to 4.1% to do the job. What that's telling them is they're taking quite a bit of signal of the fact that the labor market seems to be getting to better balance, even without the unemployment rate rising very much. So they're more confident that the labor market can essentially normalize on its own, that the Fed doesn't have to generate as much slack in the labor market to get inflation back down to 2%. So it's and Chair Powell talked about the increase in labor force participation. He talked about the fact that the ratio of unfilled jobs to unemployed workers has come down. So they're taking quite a bit of positive signal about how the labor market is developing.
Well, if the economy develops ambiguously, as you say, over the next couple of months, would you be surprised if they raised rates again?
I think at this point they probably think that they will not have to, but they know that if they're going to move in one direction or the other in the next few months, it's definitely a rate hike, not a rate cut. So I think it's going to depend on how the data unfolds, and as the press conference. There's a lot of discussion in the press conference. There's a lot of shocks hitting the economy right now. Government shutdown, auto workers strike, the beginning of student loan repayments, oil price shock. So I think the Fed may not actually have the government data in terms of the economic releases if the government shutdown goes on for any length of time. So I'm going to be very surprised if they hike in November, and then we'll see where we are at the December FOMC meeting.
Yeah, we'll see where we are, and that's something that Powell made extra clear. They're going to proceed carefully, cautiously. Bill Dudley, thank you so much. Bill is Bloomberg opinion columnist, senior advisor to Bloomberg Economics, and of course, the former New York Fed president. And of course, our thanks to Bloomberg's Michael McKee in Washington. Here in New York with us right now to continue the conversation after the Federal Reserve policy setting meeting is Torsten Slok, partner and chief economist at Apollo. It's so good to see you here in studio today. Did Jay Powell come across to you as hawkish or dovish?
Well, I think the clear signal they want to send here is that we need to slow this economy more down. I mean, they could have decided to hike rates today. Obviously, that was not market expectations, but I think this was a very hawkish pause. I mean, the whole communication, the way that the statement was written and changed, and what he said at the press conference, it clearly signaled that we can allow ourselves to keep rates higher for longer, and taking 2 cuts out of next year, by definition, means that rates will be higher for longer. And the fact that, as Bill Dudley just mentioned, the fact that this is happening without any increase in the unemployment rate today is 3.8. And now they see it going up to 4.1. That's really almost a rounding error. So saying the labor market is just not going to change in their forecast, that is quite incredible, in particular when they at the same time say we're worried about inflation. And they're really saying we're worried about inflation being too sticky, and therefore the risk that inflation might not come down to 2%.
Well, Torsten, seizing on the idea that higher for longer is really the takeaway from this decision, from this presser. I want to go right to your notes, because you wrote before the decision that rates and therefore the cost of capital are going to stay elevated for another 9 to 12 months, and credit and equity investors should plan accordingly. What should that plan look like? Because I look at the equity market this year, I see it double digits higher, look at credit spreads, and they're pretty tight. I
know, but what's going on, and he was asked about this also, is that you're seeing both for consumers and for firms, higher interest rates or higher cost of capital are beginning to bite harder and harder. We're beginning to see delinquency rates going up for consumers on credit cards and auto loans. We're beginning to see default rates going up on high yield. If we are going to keep rates at these levels for another 9, 12 months, we should be extrapolating the current lines for what's going on with delinquency rates and default rates. And that runs the risk, in particular in high yield, where default rates are now up to 4.3 in the data for August that just came out, that could continue for the next 6, 9 months. And that's then going to open up a risk that if we begin to see the cost of capital bite harder and harder on companies every single day that cannot either get a new loan or refinance an existing loan, we begin to run the risk, of course, that we'll begin to see more companies defaulting. And on the consumer side, more people falling behind on their payments. He was asked about, are you worried about delinquency rates going up for consumers? And he said, oh, this is just a normalization. But I think the important thing here is, why is it normalizing? Because interest rates have gone up. So I do think that high interest rates are biting both on consumers and on corporates. And they're going to allow that process to continue now for potentially even not only the next 9 to 12 months, but maybe even the next 18 months, because they're going to keep rates higher. And I think that process is exactly what I would call the crystallization of the transmission mechanism of monetary policy, trying to slow the economy down gradually more and more. And that's the process that we're seeing across the board, both for consumers and corporates.
And Powell really did make that correlation, maybe not explicitly, but as explicitly as we're ever going to get out of a Fed chair, when he did talk about this idea that if the economy strengthened or did perform better than what was already in their projections, then we were going to get more hikes here. So he's basically sending that message loud and clear that at least the economic activity we're at right now, that might actually be the baseline, or I should say maybe the top line.
Absolutely, because think about it in credit markets. We are every single day when interest rates and cost of capital, as Katie has just highlighted, are at these high levels. This is having real implications. There are real firms that need to roll over loans. There are real firms that need to think about, do they want to have a new loan? And if the cost of capital stays at these levels for another year, that means that for the next 3, 4 quarters, we are likely to see the increase in default rates, in particular for lower rated companies in loans and in high yield, continue to slowly grind higher. And this becomes a difficult process to manage for them, in particular if this starts to spread. Remember, there's about 11 million people who work in the companies that are high yield issuers. So that means that from a total employment perspective, there's potentially a lot of people in the high yield industries that are at risk of losing their jobs if this default cycle continues.
I'm curious, when you looked at the SCP numbers today, the economic projection numbers today, are they pretty much in line with your own outlook?
Yeah, I would also expect the summary of economic projections, as it said, that things are still okay for now, but they are projecting, and that's also what I would expect, that's also what the consensus is expecting. They are expecting that things gradually continue to slow down. Remember, they have 2 goals, of course. They have inflation and they have employment, and you need to have a soft landing, not only in inflation, we are well on track there, but we also need a soft landing in the labor market. And the fact that they are almost saying that we have almost achieved a soft landing because the unemployment rate is very close to the end goal where they think it will be in 2 years, that's saying that we can get inflation down with no implications for the labor market. That would be quite remarkable when you at the same time think about how companies, as we speak, are seeing default rates going up, in particular, again, for lower rated credits with higher leverage and lower interest coverage ratios.
All right, Torsten, really appreciate your time. Great to see you on set with that instant Fed analysis. That is Torsten Slok of Apollo. Meanwhile, you take a look at these markets. Stocks down, yields up. Bloomberg's Jess Menton standing by with a check.
Okay, Katie, Romaine, and Scarlet, taking a look at the S&P 500, the round trip it's made since the Federal Reserve first began raising interest rates in this cycle back in March of 2022. If you look in that span, the S&P 500 is up close to about 4% in that time frame. But also, if you look back where it bottomed in October of last year, up well over 20%, actually around 23% at this time frame. But if you're looking at where things are trading today, not a ton of movement as stocks have been fluctuating this afternoon. Typically, historically, over the past 3 decades, the stock market, usually on Fed days, the S&P 500 does end flat. But going through today, there actually has already been 101 trading days since the last time the S&P 500 has seen a decline of at least 1.5%. So today would mark 102 trading sessions. That's the longest streak since 2018. So it's going to be interesting to see. Apparently, this wasn't necessarily the catalyst that investors may have been expecting to see a downward decline there, but something to definitely keep an eye on. Katie, Romaine, and Scarlet.
Jess, great roundup. Really appreciate it. And you know it's a big day because Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey is in the New York office coming up from Princeton. And Ira, it was really interesting listening to Jerome Powell. He brought up real yields multiple times. Just to go through some of the headlines here, he said that real interest rates are, quote, meaningfully positive now, and also that they need to stay positive for, quote, some time. When you think about where real rates are right now, you think about 5-year real rates well above 2%. How much of a tightening impulse is that doing for the Fed?
Yeah, I think that the tightening and the real rate environment is exactly where the Fed wants it. So I think the question becomes is how long do they keep it there? And then what happens if, say, inflation continues to come down a lot and therefore real rates just are even higher, right? So one of the things that we looked at in a note this morning was where the market is pricing the expectation for the real Fed funds rate a year from now. And basically where the market's thinking that actually real rates are going to come down a little bit because this morning anyway, or last night when I put the piece together, everyone thought that the Fed might, be cutting interest rates a little bit more than they think now, right? But I think that the fact is that the market still wants and still believes that the Fed is going to be able to hold the policy rate above inflation for at least the next couple of years.
One question I thought was really interesting was the question on the efficacy of rates. This idea that households and businesses that should be hurting more from the steady increase in rates have actually done okay, in large part because they locked in lower rates, either through 30-year fixed rate mortgages or refinancing before the Fed began raising rates. What did you think of Chair Powell's explanation about how just balance sheets are healthier than we might have expected?
Yeah, so he didn't mention this directly, but it all goes to the long and variable lags argument, right? So it's just a longer and maybe more variable this time in large part because of what you just noted, right? A lot of basically the terming out of debt, both by the household sector and the business sector. And it's something that's basically been going on since the late 1990s. So this is a generational shift. It just means that it's going to take monetary policy longer to work. It's not that monetary policy won't work. It's just that it takes much longer to feed through the system. When 25% of corporate debt was in commercial paper and it was all 2 and 3 month CP, that affected the market immediately.
Yeah.
There's no more CP as a share of corporate funding, right? So it's not going to affect businesses and business activity as much now. But over time, you have less CapEx, right? Because maybe you're not willing to borrow a little bit more to do that capital expenditure that you would have. But again, that's a much longer, that's a 3, 4, 5 year type of activity rather than 3 months or a year.
All right, Ira, great to catch up with you here, Ira Jersey, over at Bloomberg Intelligence, the chief U.S. interest rate strategist there as we continue our special coverage of the Fed Decides here on this Wednesday afternoon. We continue to count it down to the closing bells as well, which are just about 14 minutes away. And Ira, we want to actually keep you here, Ira, if you can, before we let you go, because you're so good. We decided to ask you additional questions. And I do have one question here about the idea that how many people were betting on the steepening of the curve, meaning investors in the market. And when you looked at the dot plot and the economic projections here, do you think that's going to be enough ammunition to actually see a significant unwind in some of those bets?
Yeah, so I think that's actually one of the reasons you've seen some of the what we call bear steepening over the last couple of weeks, which is people thought that maybe the Federal Reserve was going to cut interest rates pretty aggressively next year. And because of that, you wind up with 2-year yields rallying a lot and 2-year yields much lower. And that was the interest rate, the steepener, and that was a consensus for a while. And I thought that for a little while, too, although I backed off from that the last couple of months. So I do think that some of the move that you're seeing today are people saying, okay, well, look, if the Fed's on hold, 2-year yields aren't going to go down a whole heck of a lot.
I want to follow up on that too, because I mean we're something like 18 months from when we first started this cycle, and really close to 2 years when you consider when you started to try to jawbone the market. Your expectations when you go back maybe to late 2021, early 2022. Compared to your general expectations now here, did they shift meaningfully?
Well, yeah, of course, because we wound up getting much higher inflation than we thought, right? We were thinking that 10-year yields would peak somewhere under 4%. We've obviously peaked above 4%. The challenge with managing money and trying to determine where interest rates are going to go, particularly longer-term interest rates, it has to evolve, right? So getting direction right ends up being much more important than getting the magnitude right, because you can always stay in a trade longer if it's working than getting it wrong and getting stopped out or losing a lot of money, right? So we thought that yields were going to go up in 2022, right? That was a pretty consensus view.
Yeah.
But we thought again like 3.3%. Now it's 4.3%. I do think, though, overall, you have to think about, for the longer end of the curve, are we near or at the peak of interest rates? And I think we probably are, but there is a big risk here because we've tested this 4.35% on the 10-year.
Yeah.
If we break through that, there's going to be a lot of stops where a lot of people like buying at like 4.25, but if you get to 4.5, those people are going to get out of that trade, and you wind up with a big spike in interest rates.
What would be the impulse for long end rates to go higher, for the 10-year specifically to reach 4.5? What would be the actual catalyst to drive it there?
Yeah, I think it would have to be a reacceleration of inflation. So basically CPI and the core PCE deflator moving up a bit. And then as that occurs, basically even more shifting of expectations for what the Fed's going to do. So I think in order to see, a 5% 10-year, you probably need to have expectations of a 6% Fed funds rate or higher, just because the market is going to continue to think that at some point the Fed will cut interest rates. But if the Fed is still hiking interest rates, then you wind up having a significantly higher 10-year yield as well. So, another 50 basis points or 75 basis points of hikes by the Fed, that might get you close to 5% on a 10-year. Now, that's not our base case expectation, obviously, but that's probably the likely market outcome of that scenario.
All right, Ira, now you can go.
Thanks, Romaine.
I think the Amtrak trains are back up and running. Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey there, helping us walk through not only his take here on those economic projections, guys, but more importantly, how the market might react should some of those projections get hit. And, of course, the big move today is in that 2-year yield, the most rate-sensitive part of, at least the main part of the curve here, up 7 basis points right now, 5.1587 and change.
The highest level since 2006. We also have the 10-year yield moving marginally higher. One thing that we were trying to figure out yesterday was the big move up in yields as well. And there are different reports, but Canadian CPI picking up, quickening in August after, it had appeared to stabilize, raising some concerns that we're going to see a similar reacceleration of inflation here in the U.S. because the Bank of Canada was ahead of us with the hawkish pause.
Yeah. And it's interesting, too. I mean, we talk about the equity market reaction. We're still around session lows here for most of the major equity indices here. And I was just looking at the S&P sectors, and basically what's leading it right now is consumer staples and healthcare and real estate.
And then you take a look at the NASDAQ 100, your big tech names. The NASDAQ 100 off by 1.2%. I thought it was interesting. It was Bill Dudley, right, who said that, okay, if you take a look at what the expectations are, rate cuts coming off the table next year, shouldn't stocks be higher?
Yeah,
right
he was
now?
puzzled by that for sure. I mean, big tech is, so, maybe that should lift the markets overall. Let's not forget that we do have earnings coming out after the bell.
Yeah.
There's still corporate news, and FedEx will be reporting. We'll be all over that.
Yeah, we're going to get FedEx, and I see you got Klaviyo up there. Its debut here on the day. Let's continue this conversation right now as we count you down to the close. Jeffery Rosenberg joining us right now, Blackrock Portfolio Manager of the Systematic Multi-Strategy Fund. And Jeff, I just want to get your take right off the top here. When you heard the commentary from Powell at the press conference and kind of the back and forth with regards to where rates might be, where the neutral rate might end up here, this seemed to be just once again him trying to work that magic on the market and keeping their expectations in line with the Fed's expectations. Do you buy into it?
Well, I think that, most of the action in this meeting, comes from the statement of economic projections. And as Powell, tried to lay out, that's not part of the committee's deliberations. It's not a plan, but it is really, the signaling of each individual participant's expectations. And so that was really the dominant story. And so Powell had to kind of navigate that. But I think it was a story that he wanted to tell, particularly in showing, higher or restricted for longer in terms of the 2024 dot. The 2023 did not have the decline. So overall, it preserves a lot of policy flexibility to become less restrictive over time. And I think that's the easier path for Powell to have taken. And I think that's probably a good outcome for him and the FOMC today.
Less restrictive over time would suggest that current policy is sufficiently restrictive. And I fixate on that clause, that phrase, because that's a qualitative, not quantitative judgment, isn't it? What does sufficiently restrictive mean in the current context? Is it a moving definition or range, or is it a fixed target during this rate hike cycle?
Yeah, and as you saw, there was a lot of discussion and a lot of questions on that. And I think the answer is sort of you know it when you see it, which is that the policy rate has the impact on the data, on the economy, and most importantly on inflation that they're expecting. So, most of the forecasts that were written down today, and most of the market forecasts basically say the Fed's going to have success here on inflation, and so therefore we're sufficiently restrictive, and we're about to move the discussion to, are you too restrictive? What about cuts in 2024? Why did you take 50 basis points out of the cuts in 2024? But that may be premature. It's basically, counting your chickens before they've hatched in the form of we're expecting that inflation decline. And if we don't get that expected decline, that's going to be a bigger surprise. Noting that, we've had a lot of failures in the consensus forecasting around inflation. Now it's too benign. Now the market is too complacent around the expectations that inflation will go back down to its pre-COVID level. I think that's where the surprise in the forecast may come from. But right now, there's pretty good consensus both at the Fed, in the SEP, and in the market that inflation has been won. The war on inflation has been won, and it's just not as Powell laid out in part of the Q&A. Now it's more two-sided and trying to secure that soft landing that is so much in the consensus, and I think is also reflected, partly in these SEP forecasts as well.
So, Jeff, how high is the hurdle for a rate hike in November? And he himself said that, it probably wouldn't do anything for the economy.
Yeah, I mean, as he said, and I think it's right, one more hike here is not really the make or break story. The story is really that they're going to be high for longer, restricted for longer. We're pretty much at the end of the hiking cycle. Whether there's one more or not, very much depends on how strong the economy is. And as he highlighted, the change from the prior forecasters really about the strength in the economy, contributing to people's unease about how quickly they had penciled in cuts in 2024. So that's really going to be the story here going forward is, does the strength persist? Does inflation not fall as much as forecast because of that strength? And the Fed actually needs to do more or hold at the higher rate. Well, both needs to do more in the form of one increase, but then hold at that higher rate for a longer period of time into 2024.
And Jeff, I'm still stuck on Chair Powell's comments on real rates, these meaningfully positive real rates. And just to recap what we've seen so far in 2023, you have 10-year real yields up about 45 basis points. You look at the S&P 500 up about 15% so far this year at the moment. I know that AI is very exciting, but when does the U.S. equity market start to respect what we're seeing in the bond market?
Well, the discussion on real rates is very interesting because, both you have an increase in kind of the projected real rate into 2024 with the 50 basis points of cuts in nominal rates being taken out at the same time as you basically maintain the inflation rate decline. Yet the discussion also brought about the longer run estimate and effectively the discussion on, what is the real neutral rate? So, right now, estimates for the real neutral rate imply that these are very high and therefore restrictive real rates. But there is this possibility, and Powell talked about it. He admitted that, the resilience of the economy might point to the fact that your neutral rates are indeed higher, that post-COVID structural changes have led to that. And, that will be the kind of historical reckoning of this tightening cycle, that if real rates indeed did go up, that we actually weren't as tight as that as we expected in real time. And that might explain the lack of the inflation decline down to the 2% level. Sort of the easy parts of inflation declines are behind us. The hard part is ahead of us. And whether we achieve that as easily as these forecasts in the SEP are implying very much depends on whether or not these real rates are as tight as we think they are today.
All right, Jeff, going to have to leave it there. Jeffery Rosenberg over at Blackrock. He basically made it clear here, guys, that I thought he used the phrase here, the hard part really is here. And I just want to quote something. Enda Curran, one of our Bloomberg reporters here, wrote something great in the live blog that we had. And he basically said, it's clear, in his words, it's clear the Fed is now in a much more, quote, complicated judgment territory than it has been. And he goes on to talk about this idea that when you go forward, these next few meetings, it's going to be insane.
What do they say about script writing, that the third act is the hardest?
I don't know. I've never taken a script writing class. What are you doing in your free
Maybe I
time?
revealed too much about myself.
Yeah, what is the script about?
You think about how close the finish line is.
Does it involve me and Scarlet?
No, it's all about the Fed, actually.
Oh, is it?
Yeah,
Okay.
basically, and how hard it is, their path forward. For
Hold that thought, Katie Greifeld. We're moving closer to these closing bells. Our full market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld and Scarlet Fu. We're counting you down to the closing bell. We're here to help take us beyond the bell. It's a global simulcast with our friends Carol Masser and Tim Senovic. Welcome to our audiences across all of our Bloomberg platforms here on Fed Day. Of course, the big headline, guys, is the Fed holding rates here at the September meeting, but making it clear in those projections that it expects rates to be higher for longer into 2024 and beyond.
Right, and it looks like, Romaine, that the Treasury trade certainly got that memo and that note and that message very clear. Your two-year note now at 5.15. I mean, we're at the highest in since 2006, I believe. So we've really seen kind of a bit of a reset again. I feel like this week it's certainly on this day when it comes to rate expectations. And we just talked with Larry Pitkaski over at Good Haven, and he said, I love what he said. I think we're in a higher rate, risk-free environment without existential worries. So in other words, higher rates for longer, get it, but maybe without some big risks.
But here's the thing. When you look at the summary of economic projections, how can you know what's going to happen in 2024? How can you know what's going to happen in 2025? It's you really, as Yelena Shaliatova over at BNP Paribas told us, you have to take anything beyond this year with a giant grain of salt. We just don't know what's going to happen.
So Scarlett, should it not be considered a plan then?
He was very clear that this was not a plan. These are the median, the average forecast among, all these different participants who submitted their numbers. And by the way, economic forecasting is very difficult, guys.
I've heard that before. I heard that today, actually, from Fed Chair Jay Powell.
I mean, not if you have a crystal ball. I don't know. Do you guys not have one?
Yeah, we don't. Let's walk you through the market numbers here. We've been talking a lot about the macro, but it was a pretty busy day for equity markets. Obviously on pins and needles about the Fed, but of course you had an IPO today in Klaviyo, and not necessarily the best trading day for Instacart and ARM once again. The net effect of it all is the Dow Jones Industrial Average lower by about 0.2%. The S&P 500 giving back almost 1% on the day, or roughly 41 points a close, right around that 4,400 level, a key technical level there. The NASDAQ Composite down about 200 points, or 1.5%, while the Russell 2000 looks like it's going to finish out the day lower by about 0.9%.
All right, quick look at the S&P 500 in terms of the names, about 173 to the upside, 328 to the downside. So certainly more of that risk-off trade, no doubt about it, and 2 unchanged, Scarlett.
Yeah, volume also slightly lower than the year-to-date average. Let's look at the sector performances here for the S&P 500. It was a down day for the major indexes, as Romaine told us, but there are some sectors that did finish higher, including telecom names, healthcare equipment, and food, beverage, and tobacco. So you're seeing a lot of those dividend plays, those safety plays come out ahead. On the flip side, you've got a lot of those big tech names, media, entertainment, semi and semiconductor equipment companies, and tech hardware, along with software and services, all leading to the downside, all down by at least 1.5%.
All right, a little nervous, making sure that my gainers actually held on to their gains, but let's go to it. Klaviyo, right? The IPO. It's been a big week.
Not all of them did, Carol. Can we just get rid of that fourth one?
Darn it, gosh.
Yeah.
All right.
Can you just block out her box?
You know.
Wow.
Again, I'm here. I can hear this. All right, so Klaviyo up about almost 32% at its highs today in its first day of trading as a public entity here. Finishing up, though, with about a 9% gain. It was oversubscribed nearly, I think, 30 times. So, it's interesting. Limited supply, another one of those kind of IPOs, but nonetheless, a gain, but lost a lot of that momentum that it saw earlier in the session. Pinterest, I want to go there because it's been on quite a 2-day rally, up another 3%. It gained 3% yesterday. Analysts were impressed by Tuesday's Investor Day, saying that the social networking company was upbeat and that the long-term targets look achievable. It's up roughly about 12-13% so far this year. And then Enphase Energy, once again, rallying up 4% yesterday, up another 1.5% today. News Monday, late Monday, after the close at co-director Thurman Rogers bought about $4 million worth of shares. It's the only news I could find, but it looks like still some momentum. Still down more than 50% year to date, and you got about 8% of the float shorted. Initially, a lot of other solar names were higher, which meant the Invesco Solar ETF was up almost 2% at its highs today, but finishing with a decline. of 0.1%. So over to you, Mr. Decliner.
Handing it off to me.
I am.
I'll take it. I'll take it. Let's talk about some of the stocks that moved lower on the day today. In the S&P 500, mega cap tech declining after the Fed's higher for longer message. Apple among the worst performers on a points basis in there. Microsoft there as well. Nvidia, Alphabet there as well. We should note that Dow Jones also reported a note from UBS's David Vogt that questioned demand for the Pro version of Apple's new phone, saying demand was not as strong as it was for the Pro models last year. And then Zebra Technologies, the worst performer on a percentage basis in the S&P 500, down 6.5% today. It's a company that makes barcode scanners, interactive kiosks, and more. Got downgraded to underweight from equal weight at Morgan Stanley. Morgan Stanley analyst writing that the pace of recovery at the consumer electronics company will likely be slower than expected. And then let's check in on Maple Bear. That's, of course, Instacart. The price for that IPO was $30. It closed today just above that IPO price. Yeah. So hung on to that, but still down 10.7% today. This after raising earlier this week, $660 million.
And the do you know why it's Maple Bear?
No. Oh. Well, anyway.
Oh, do we have something more important? Let's go to something more important.
Well, something more important, I would say, is the bond market. Yeah. I know there were some interesting single stock stories, but on Fed Day, of course, we got to take a look at what's happening across the Treasury curve, all the action in the front end. As you can see there, you have 2-year yields managing to rise 6-7 basis points, 5.15%. That is the highest 2-year yield since 2006. You go out the curve, not as interesting. You have 10-year yields. I'm going to call that unchanged. Your 10-year yield about 1 basis point higher, 2 basis points higher, 4.37%. That curve back to inverting rather at about negative 78 basis points remain.
Yeah, we actually still getting some earnings, believe it or not, here. That's kind of the last stragglers from the past quarter. FedEx out with their numbers here for their fiscal first quarter. Revenue coming in at about $21.7 billion. That's a smidge lower than what the street was looking for at 21.84. But operating income does look like a pretty solid beat at $1.59 billion versus a street estimate on average of about $1.34 billion. Here's your forecast here. The company basically saying that it sees full year adjusted EPS at $17 to $18.50 a share. The previous guidance it gave was $16.50 to $18.50, so effectively just raising the lower end of that range by about 50 cents. You can see the price reaction there, the knee-jerk reaction higher by about 2%.
And of course, when it comes to FedEx, what's notable, of course, is how it stands in contrast to UPS. UPS had to give big pay raises to its workers who had threatened to strike. FedEx, of course, is has been cutting costs and has been doing that. And the CEO says that they're well positioned to deliver, they've started fiscal 2024 with strong momentum and are well positioned to deliver improved profitability. So kind of just putting that out there and reminding everyone.
Yeah, they're not apples to apples when you look at FedEx and UPS. We often talk about their different models, but man, investors have been really sitting up and taking notice of what FedEx has been doing in terms of transforming the company. I mean, it's up more than 40% this year. You've got UPS down about 9%. There, of course, have been, concerns with the strikes and so on and so forth. So very different stories for these, but it really does feel like Wall Street investors have taken notice of what the changes they've made.
But it's interesting, too, to look at this report as well as a couple of the reports and to sort of tie that into some of the questions that Powell was peppered with here. This isn't a revenue growth story. I mean, this is cost cutting. And I think this is the fear that a lot of investors have that, that's great in the short term. It gets you through the quarter and it bolsters the stock price. But how much longer do we go like this, particularly if you do believe that rates are going to stay higher? Yeah,
the press release, Romaine, literally spells that out. It said that first quarter results improved primarily due to the execution of the company's DRIVE program and continued focus on revenue quality. But, and this is a big but, the improvement in operating results was partially offset by ongoing demand weakness.
That's the thing. I mean, it's you can cut costs. No one's poo-pooing that, right? But you can't sort of cut your way to prosperity, more or less, right? And you sort of wonder what the strategy is for FedEx. And we don't want to just pick on FedEx here. A lot of other companies are in the same boat as them. Other blue chip companies are in the same boat as them. And I wonder if that's sort of the next thing that the Fed really has to be mindful of. We so focus on the consumer and the homeowner, but we forget there's stresses out there for businesses as well.
But maybe against this backdrop, that's good enough. And you can see that in the share reaction After hours, FedEx shares up 2.5%. To your point that, I mean, that's not necessarily growing, that's cutting costs. But you think about some of FedEx's peers, maybe cost cutting is good enough to make it stand out.
Well, and sometimes you have to clean house, right, to get to a better business strategy or business equation. I do also want to mention that, and could be another reason why the stock is popping. Company expects to buy back an additional $1.5 billion in shares during fiscal 2024. We see companies doing that a lot, when they've got some excess cash. Again,
so $1.5 billion to buy back the stock.
Right.
Not into CapEx, not into the business.
It's not building the business.
Okay, gotcha.
Paying workers, whatever.
Okay.
But it allows you to buy time while you wait for things to recover, right? I mean, Jay Powell made it really clear that the economy is doing better and holding up better than a lot of people anticipated, certainly than the Fed anticipated. And so demand might be more muted than it was before the rate hikes, but it's held up for the most part.
No, you do wonder, right? You can't cost cut your way to, a really strong company, but you can certainly make investors happy maybe for a little while. So more to come, certainly, on that story. Guys, that's a wrap. All right, that'll do it for our cross-platform coverage.
Happy Fed Day.
Happy Fed Day.
Good to see 5 of us.
Yeah.
Did Tim say big butt before?
No.
He did. You did. It's
On
a
what?
big butt. You said that.
Oh, okay.
Sorry.
Maybe I did.
I know. I'm being like an 8-year-old again. That's a wrap. Our cross-platform coverage, radio, TV, YouTube, and Bloomberg Originals. We will see you again tomorrow.
Stick with us. A lot more coverage coming up here on Bloomberg Television, a reaction to what we learned out of the Fed today, a reaction to what we learned in markets as well. David Bailin from Citi, John Taylor from Stanford University, and Raghuram Rajan, former India Reserve Bank governor. All that and more coming up in just a bit. This is Bloomberg. A down day for equity markets, an up day for yields, the most severe price reaction, the most severe volatility, of course, coming right around the 2 p.m. mark here in New York when the Fed released its decision. The big thing, though, the big takeaway, though, that we learned from that press conference, from Jay Powell, and from those economic projections is the idea that the economy has held up way better than what the Fed had originally projected when it embarked on this rate tightening campaign about 18 months ago. And so, too, did the market. In fact, the S&P, while down about 0.9% on the day, believe it or not, actually is still hovering just slightly above the levels it was at in March of 2022 when the Fed started this rate tightening cycle. So a market that has been through a lot of ups and downs ever since then, but the net effect of is that it's held up and, more importantly, delivered for most investors some modicum of return. The Dow Jones Transportation Average slightly unchanged here on the day. While we did finally see a pullback in the oil markets, we saw a pullback in gold, and we saw a bid come back into the dollar. That's basically the cross-asset story right now, minus what we saw in yields. But let's talk about what we saw in yields today. Of course, there will be a lot of talk about the 2-year yield hitting the highest level since 2006. But quite frankly, most of the Treasury curve right now has been camped out at some of those levels that we've seen back in 2006, 2007, and 2008. That includes your 10-year. That includes your 5-year here. A cycle right now that has us at these, well, let's just call it a cycle high, a generational high, if you will. But if you believe those economic projections and if you believe the words that came out of Jay Powell's mouth, these lines will continue to creep higher.
Yeah, I like the way you put that generational high. Well, the Fed's ongoing draining of its balance sheet has also removed a backstop for a key corner of the funding space. And that is fueling volatility in the market for repos, repurchase agreements. For more, let's bring in Bloomberg's Alex Harris. I think we tend to forget that at the same time, there's still quantitative tightening happening. Why is this important?
Yeah, I wish we would have heard a little bit more about it in the press conference today because it is important. And especially if you think about it in the context of these basis trades, the whole foundation of a basis trade is you're taking a position in futures, but you're also taking a position in the cash market for treasuries. And those trades that leg gets financed in the repo market. So now if you're trying to finance basis trades and now you're looking for paper and it's not there and you can't go to the Fed and get more of it because they're backstop, they're not holding as many treasuries anymore. This gets really expensive, and it makes for a very, very volatile repo market, more so than we already see just on typical periods.
But why don't you think that Powell is, at least publicly, doesn't seem to be as concerned about it? I mean, he only really mentioned this once on his own, and I think one of the questions that was posed to him on this, he kind of didn't really even answer it.
I think there's just so many wild cards when it comes to the balance sheet in terms of reserves. You know, the key question when everyone talks about the balance sheet and quantitative tightening is this lowest comfortable level of reserves. What's the total number of reserves that banks need to be holding on to before you hit that point of scarcity, before the markets get volatile and we get something similar to a blow up that we saw in 2019. And after March of 2023, after SVB and the other bank and the turmoil in the banking sector, nobody knows. And there was a senior financial officer survey that the Fed released in August. And they were saying that those levels are actually much higher than they were at the beginning of the year. So now the calculus has changed and nobody knows. And it's a big wild card. And I think if you're the Fed, you need to present confidence that this is going well.
But if you're the 19 members here on the FOMC, or if you're the staff providing these reports, and you go into that next meeting, October 31st, November 1st, and you have to discuss this issue here, can't you make a case, and I think Powell used this phrase to some degree or another, of normalization, the idea that while there is some ructions going on in the market, it's kind of just taking us back to what, in his mind, where the market should have already been?
Yeah, yes and no, but again, it's like that risk of going too far, and that's what we saw in 2019, and I think that's what really has people concerned is when the Fed isn't quite sure of where that lowest comfortable level of reserves is, where that flat part of the demand curve is. You know, that's what gets them scared, because if they don't know, nobody knows, and then you risk running into, you know, and creating this volatility and creating this turmoil, and then that causes an abrupt stop to their whole plan. So that means no rate hikes, because how do you communicate that you're stopping the balance sheet unwind while you're still raising interest rates? And communication, let's face it, isn't necessarily the Fed's strong suit in trying to work with these dualities.
Yeah.
All right, Alex Harris, great to see you. I know it's been a busy day for you.
By the way.
You do?
I think it's the best we've had in years.
You think he's doing a good job?
I didn't say good. I just said it's better than what we've had in the past.
He's doing a job. I agree with that. Well, let's ask our next guest that question. We have Andrzej Skiba. He is RBC Global Asset Management Head of Blue Bay U.S. Fixed Income. And Andrzej, come into that debate that we just had. When you think about what we heard from Powell and what we've heard from Powell really over the past couple of years, how would you rate his communication job?
Well, hello. Thanks for having me. It's been a difficult message because Fed is essentially telling you it's all going to be okay on multiple fronts, that growth will come back soon close to long-run averages, inflation will moderate, and unemployment will only tick up modestly. And there is a fair dose of awareness within the market that Fed's projections have changed dramatically every 3 months, quite a few times when you're looking at historical summary of economic projections. And what we could be hearing from the Fed 6-9 months down the line could be very different from the very benign message that we're hearing today. So there is a fair amount of questioning. Is it too good to be true in terms of the forecasts?
Yeah, and I think that question was put to Jay Powell as well when people kept pressing on this idea of a soft landing. What surprised me is that I think for the first time I heard him say that the soft landing or a soft landing is a primary objective for the FOMC, even though we know it's not part of its mandate. Do you get a sense that policymakers are getting ahead of themselves here in talking up the likelihood of a soft landing? New York Fed President John Williams recently said recession talk in the finance sector has basically vanished.
Look, there is some truth and validity to that concern, that how much are you locking yourself into specific outcomes. But at the same time, Chair Powell was careful not to say that that is their base case scenario. So that still opens the door to responding to changing economic conditions over the coming months and quarters. And at the end of the day, after so many hikes and also meaningful tightening of bank lending standards that is filtering through the economy, it would be really surprising to see everything proceeding very smoothly over the quarters to come. So saying that soft landing is not a base case scenario, we think that is appropriate.
Then when you measure up the market reaction today, and we'll see whether this actually carries over beyond just a couple of hours post-meeting here, but we talk about the direction of the yield curve right now, pretty much across the board. We talk about inflation expectations, if you go out at least 2 to 5, 10 years, seem relatively grounded here. And of course, you had the big sell-off on the front end of the curve and somewhat sparing the longer end of the curve. What does that tell us?
Well, higher for longer seems to be the theme of the day. Doves did not get any interesting news from the press conference. So the market is adjusting front end of the rates higher, and the expectations for maybe middle of the year cuts next year have been pushed out to maybe July or September. And look, we will see how the data is evolving. It is very clear that the world can look very different 6 months down the line. So we should be open-minded to Fed adjusting communication further down the road. What was interesting, though, is how some of the FOMC members have changed their long-run rate expectations. So there's been this great debate about what is the R-star, what is the neutral rate, and is there a need for that to increase? And we have now seen the evidence in the summary of economic projections that the range of estimates has actually, the upper band has moved up. And Chair Powell has also admitted that it's a possibility that it's higher than Fed is currently forecasting. And when we're looking at fixed income universe over the coming quarters, how that debate is unfolding will also have meaningful implications for how risk assets are doing and whether people are taking advantage of the current high yields within fixed income or taking a step back.
Yeah, and it's interesting, too. We should point out a unanimous decision today, and we should point out all the meetings we've had going back to March 2022, all but 2 of them unanimous. Andrzej, great to catch up with you. Andrzej Skiba there over at RBC Global Asset Management. We're going to continue this conversation, our special Fed Day coverage, continuing with David Bailin, Citi Global Wealth Chief Investment Officer and Global Head of Investments. That conversation coming up after the break. This is Bloomberg. The Fed decided earlier today, and the decision was to leave the benchmark interest rate unchanged. The second pause in this rate hiking cycle, but Jay Powell, as well as those economic projections, signaling that another hike could actually happen this year, and he expects rates to be higher for longer through 2024, maybe into 2025. As to what this means for the global markets, let's get some insights out of David Bailin. He's Citi Global Wealth Chief Investment Officer and Global Head of Investments. And David, the market today had the knee-jerk reaction largely to the downside here, at least on a price basis. When you look out a little bit further over the next few months as we try to sort of figure out where the Fed goes next, do you think market sentiment is going to be, I guess, somewhat commensurate with what we heard out of Jay Powell today?
When you look at the macro trends that underlie the decision that the Fed made, they're actually pretty positive, right? They increased growth rates for this year and for next year. They're talking about an economy that is essentially resilient. They're talking about earnings probably that are higher than have been expected. And so what they're talking about is an economy that's going to take a longer time to slow down to allow inflation to get to their target, 2 to 2.5%. So to me, the underlying economics, for the economy and for what earnings could be next year are actually pretty positive. From a rate perspective, what's happening is that you're obviously seeing, higher rates for longer. And if you think about what that does, is it makes investors much more likely to consider the possibility that they're going to consider fixed income more primarily, which is going to dampen what I think equities can do. So the net impact of this over the next year and a half, I think, is going to be pretty positive for equities, but it's going to take 18 months to see that come through.
Wow, 18 months, yeah. So it's going to be, when you look at what's to come, are bond yields going to be driving equity prices then in the near term if it's going to take 18 months for things to filter through?
Well, we're going to see equities go up, I think, over the next year. Let me give you some sort of context for this. The context is that if you think about where we were at the end of 2022, we had been through one of the only 2 years in 100 years where you saw both bonds and stocks go down. In those last 2 instances, when you look 2 years later, the average 60-40 portfolio is up 20%. So it's possible, and I think it's likely, that we're going to see portfolios, 60-40 portfolios, do that by the end of 2024. So a combination of profits in fixed income as inflation abates, and due to the fact that equities themselves will actually appreciate as earnings actually rebound. 2025 could actually be the first normal post-pandemic year that we have, and I think that's what's going to play strongly into portfolios for clients.
All right, 2025, a year of normalcy, hopefully. And David, since we have you, I want to get your thoughts on some of the recent things that we've seen in the equity market outside of the Fed decision today. When you think about some of the huge IPOs that we've seen, huge by recent historical standards, what could this mean for the IPO market going forward and for the equity market going forward?
Right. So we just wrote a little bit about the fact that the IPO market reopening is a big deal. But it is not something that's going to take place with any great speed. There are several hundred companies that could go public. The valuations, with the exception of the semiconductor company, have been normal, market rates. But I do think the reopening is a big deal in the sense that it's going to drive investor sentiment, more positively. We see the market opening much more for IPOs in the next 6 to 9 months than we do over the course of the next few months. But in general, again, that's a positive thing. We need to see rates ultimately peak in order for the equity markets to really have, some more momentum. And I think the other thing that we should look for is labor, actual employment numbers going down. No one's really talked about the fact that the real Fed declines in interest rates are going to occur when we see labor, initially even more levels of employment dropping and ultimately going negative. The Fed has a great history of stepping in at that point and saying, wait a minute, we've got to support the labor economy. That data could be 3 months from now, could be 6 months from now. But with this level of tightening and with money supply actually negative, it's more likely than not that we're going to see a negative impact, to labor that people just are not anticipating in 2024.
All right, David, great to catch up with you. David Bailin there, Citi Global Wealth CIO and Global Head of Investments. Stick with us. John Taylor up next. Romaine Bostick here with a look at how markets perform here on this Wednesday, a Fed decision day. And the decision by the market, it was very volatile here. Right around 2 p.m. Washington time, we saw a huge spike higher in Treasury yields, and we saw a huge drop lower when it comes to equity prices. That was the net effect overall, with the big drag coming from the tech space. The Philadelphia Semiconductor Index down almost 2% on the day. And as far as a Magnificent Seven, nothing really there to talk about today. All 7 of those stocks lower on the day, including Apple and Amazon down for a 5th day. In fact, Amazon now erasing all of its gains for the month of September here. You did see a slight uptick in the dollar. Finally, some perking up in the VIX index right now around 15 here. And a big stay in the crude oil space. The net effect, though, was the WTI pulling back by about 1% here on the day. That's the knee-jerk reaction here on this Wednesday. Of course, Scarlett, we're going to have to wait for the next few days and weeks to get a better sense here as to whether this price action sticks.
Yeah, but that was the knee-jerk reaction. And you look at those red up arrows, red, of course, indicating lower prices for treasuries, and the up arrow indicating the move up across the yield curve. And that is the picture here following the latest Fed decision and, of course, their economic projections as well. Let's bring in Bloomberg's chief correspondent, Global Macro Markets, Liz McCormick. Liz, you recently wrote that the dot plot, the updated economic projections would be a key decider for where the Treasury market goes next. What did you gather from this latest dot plot?
Yeah, I really like the dot plot today because I feel like the Fed out-trumped what we thought, because a lot of investors were saying next year what the dot plot shows, they thought they would take away one of the cuts because there was 4 signaled in June, but the Fed took away 2 cuts. So they kind of slashed in half how much easing they'll see next year. So, to me, it's about, because, the Fed did signal one more hike this year, but whether they do it or not is kind of very marginal. But it's how long do they stay there? And the Fed seemed to really double down on it is higher for longer and we mean it, and that's why, like Romaine was saying, there was a lot of volatility, but now both short and long end rates are up for the day.
So, Liz, you love the dot plot. I don't know if Jerome Powell necessarily loves the dot plot, but
remember when he said he was going to kill the dot plot?
That didn't happen. You can't kill a good dot plot. But you made an interesting point before the camera started rolling. Actually, the median long run dot didn't change, but the average has actually been moving around a little bit.
I even brought my wonky papers
Is this
and
where you're going to
highlight.
explain us the difference between median and average?
And I was
mean?
looking, the mean. I did take
as a kid.
statistics
Yeah.
in my life, but I was looking, and even though the long run dot is stayed at 2.5, that's the median that we look at, but the average, which our Bloomberg people are great to put out as well, did go up almost 10 basis points, to like 2.7, say 6 rounding from 2.66 in June, the last updates. And Chairman Powell even said that, there's a chance that that neutral rate, what we call the R star, which some people look at that long run dot as somewhat of a proxy, could be getting higher because the economy's been more resilient and other factors. So I see a lot of investors, that's what they're paid to do, kind of deep in the weeds saying, hey, that long run dot may be moving. So we have less cuts coming in next year, higher for longer. And, think of the long run rate for the Fed as kind of the base rate of a lot of policy. Mm-hmm. So if that's higher, that you've got to kind of nudge up rates in the Treasury market across the curve on that.
I'm curious about the market reaction, and we were speaking with your colleague Ira Jersey over at Bloomberg Intelligence, and I thought he made a good point here that even if we do start to see an uptick in yields here, is there some sort of threshold where then all of a sudden the market positioning sort of kicks in and then actually exacerbates that move?
Well, I think, one yield my colleague Mike McKenzie and I talk a lot about is 4.5 on the 10-year, right? That people thought, we couldn't get there. And there's a lot of people saying, if we break 4.5, then that might be that trigger. Because people keep thinking, we can't go that much higher. But then when they do, you start seeing stops triggered. People have to scramble out. And then you see that kind of rapid, those jump moves. So, I mean, I'm old enough to know, like, maybe 5 on a 10-year is not that high, right? So I think Ira's right that you have to watch. Things can go gradual until they don't, right? And you hit these trigger points.
Yeah, I think the more useful dot plot is they just took all those stops that the market has and just published those, made those public. Then we'd have a better sense of what's going on. Liz McCormick, Chief Correspondent for Global Macro here at Bloomberg. We want to keep the conversation going right now with John Taylor, Professor of Economics at Stanford University, Senior Fellow in Economics at the Hoover Institution, formerly, of course, with the Treasury, and of course, the creator of the namesake Taylor Rule. And Professor, I want to start off here with this idea, this balance that I think Jay Powell is trying to create here, the idea of continuing here with the hawkish policy while still encouraged by a relatively resilient economy. And I just want to read you a quote here, because there were 2 papers that came out, one this month and one that was presented at Jackson Hole, and they both made the same case that, quote, the majority of disinflation has been driven by expanding supply rather than decreasing demand.
You want me to react?
I do.
Well, I think that's missing the point. You remember, it was just a little over a year ago, the interest rate was 25 basis points. So while we have come up quite a bit, it's still not quite all the way. I think I'd feel a little better if they did 25 basis points as well. But, we went 25 basis points to 5.25, 5.5, and that's a good step. So I think that's what's happening. They signaled it, they were clear about it, but and it hasn't done the damage we were worried about.
Professor, I want to get your take on wages and how they fit in here. Do wages follow inflation, or do wages cause inflation? We know that the global economy has seen some big structural changes after the pandemic, and here in the U.S. we continue to have a relatively tight labor market. Is there any reason to expect wages to continue to cause inflation in the future?
I don't think so. I think it goes both ways. Sometimes it's inflation, sometimes it's wages. I think at this point, we have inflation, which is well above 2%. It's not 9.1 like it was a year and a half ago, but it's over, say 4%, 3.5%. So we got a ways to go to get it down, and that's the main thing, which is affecting wages, and thereby affecting prices. So that's the main goal, and I think we referred to the Taylor Rule for a few minutes ago. The Fed has recognized that. They're very close to it now, not far away at all, like they were a year and a half ago. So that's a good sign.
And let's talk a little bit more about the Taylor Rule, because you have your own function on the Bloomberg terminal, TAYL, and you look at the current Taylor Rule estimate, it clocks in at about 8.6%. You think about the upper bound of the Fed rate now, that's at 5.5%. Would 8.6% make more sense, or would you tweak that model?
Well, the one I use says about 6%, so it's really close to where it is. And remember, it was 5.5%, 6% when the interest rate was 0.25, and so that's really what things should be thinking about. what people should be thinking about. I would not recognize going further at this point. I think the Fed is right to slow down a little bit, maybe not pause completely, but I wouldn't go as far as that. And there are different versions. The Taylor rule that I use says around 6%.
All right, you need to share that with us, John, so that way we get it right next time. In all seriousness, we talk about this idea of sort of what that neutral rate might be, how long the Fed keeps it there, and the economic ramifications, if you will. If 5.5 percentage points of rate hikes didn't necessarily destroy this economy, are we to believe that holding it there or holding it even a quarter point higher would do that?
You know, the thing is to look at that inflation rate. It's still 4%, 3.5%, supposed to be 2%. And I think it was good that Jay Powell emphasized that that was their goal. So they're not there all the way at this point. And I think that's what people should be looking at. Whether you look at a Taylor or whatever you look at, that's what's telling you. And so that's a little bit more. I think hold it a little bit longer. If we're lucky, it'll come down faster. But so far, it has come down quite a bit, but not all the way.
Once the Fed does wrestle inflation to 2% and can end this hiking cycle at wherever it does, do you think that that resets everything, kind of clears the board so that perhaps we can get back to a rules-based approach to monetary policy?
Well, in many respects, we're already back to it. And so, you know, 5.5, 5.25, 5.5 is very close to 6. So I think they were far away, and I wish there were more emphasis on how far away they were. But we were already back, and many other central banks around the world, the Bank of Japan, the ECB, are following the same strategy. So I think it's a good sign that the rules didn't work so well when they were off them, and they're working better now that you're closer. So let's focus on that. I think that's what I get out of this.
All right, Professor Taylor, always wonderful to catch up with you on days like today. John Taylor over at Stanford University here on a Big Fed Decision Day. Our coverage continues in just a moment with Raghuram Rajan, professor of finance at the Chicago Booth School of Business, and of course is also former Bank of India governor and former IMF chief economist. Going to get his thoughts on the Fed, and why not? Let's just push ahead to the BOJ as well. This is Bloomberg. Our coverage here of The Fed Decides continues right now with Raghuram Rajan. He's a professor of finance at the University of Chicago Booth School of Business. He's a former governor of the Reserve Bank of India and a former chief economist at the IMF. And I want to start off, Professor, here with an interesting exchange that we heard during the press conference here, where Powell was kind of talked about his baseline expectations for economic conditions and that proverbial soft landing here, at least as of right now, where I know we're only 18 months into this rate hiking cycle, but at least for right now, it seems that the elements of a soft landing are there. And if you believe their economic projections going out over the next 2 years, that seems to reinforce it as well. Did you also have the same takeaway?
Yes, but look at it. The reason you want to say soft landing is the economy has resisted, all that has been thrown against it and is still, projected to do very well this year and maybe slow a bit into next year. So that's suggesting a resilient economy. But a resilient economy is not necessarily good news for inflation. So it does raise the question, is the Fed right to be as confident about the path of interest rates if, in fact, the economy exhibits the kind of resilience it's showing? Now, what plays into Chairman Powell's statement is that he believes the economy is also slowing. So it needs sort of a combination of circumstances, slowing but not slowing too fast. And the interest rates are doing their job, so they don't have to raise interest rates too much more. And it all works out really well. And this is why most people say, yes, it is a possibility, but we must consider other possibilities also.
Given where we're at right now, in your view, how much of that can actually be attributed to monetary policy, to Fed policy? And I'll pose the same question that I posed to Professor John Taylor just a few minutes ago. This idea that, at least based on some economists' estimates, a lot of the disinflation we've seen has come more from the supply side rather than the demand side that we typically associate with the monetary policy tightening cycle.
Well, it is a bit of both, but to the point that it seems more like the supply side. Yes, we have seen supply chains essentially reestablish themselves. All the disruption during the pandemic, that has gone away. So that's been on the supply side. But on the demand side, yes, there has been some slowing, for example, in the housing sector. But clearly, there hasn't been as much slowing as one would have expected with a 525 basis point hike in interest rates.
What about the external factors, the things that Jay Powell wouldn't answer, but everyone kept trying to press him on? Things like a possible government shutdown, the student loan repayments, the strikes that are currently taking place in Hollywood and in the Midwest with the auto workers. How can the Fed be so optimistic about GDP, at least in the near term, when there are so many headwinds out there?
Well, there certainly are headwinds, but there are also tailwinds, right? One of the interesting factors over the last couple of quarters has been productivity growth seems really, really strong. So if that plays out, it's not just a blip, but it plays out for some time, that would be a positive factor for growth and would actually be positive for the fight against inflation, because it would mean we can sustain higher wage rates without necessarily that translating into higher inflation. So yes, there are a mix of factors. I think the big unknowns are how fast the economy is going to slow going forward, given what has already been thrown against it. And of course, the factors you mentioned, the withdrawal of fiscal support, for example, because of higher student loan payments having to be made. And of course, the inflationary effects of these strike settlements, not so much in the direct impact, but what it sends as a message to what appropriate wage rates might be in the economy.
Strikes, of course, a big unknown. Another big unknown is what's going to happen with energy prices, what's going to happen to the price of oil and this incredible rise that we've seen over the last few months. What is the read-through from higher energy prices into inflation expectations and thus into Fed policy?
It absolutely matters, right? Because one of the worries is the higher inflation caused by energy prices. Fuel prices at the pump are very salient for people. As they see that and start thinking, yes, inflation is back with a vengeance, and then that starts feeding into wage effects, and that becomes the second round effects that central banks really fear. So we're not done, which is why I think Chairman Powell made it very clear that he wasn't in any way saying mission accomplished, that there's a long way still to go. And some of these blips can turn out into something more that requires more Fed action. So I think the message that we have to take away is so far so good, but a lot remains to be done. And really, we don't have a whole lot of economic models to tell us how this is going to play out.
And of course, the Fed is just one of many central bank decisions that we have this week. The action starts again tomorrow morning. We get the Bank of England decision at 7 a.m. New York time. I know there was better than expected, cooler than expected inflation out of the UK today. Do you think that's a game changer for the BOE?
I mean, it does seem that the BOE is somewhere near the, near a point where they will feel comfortable pausing and watching. I don't think any central bank at this point is going to say it's done. The question is whether they go with another rate hike, given their higher rates of inflation, or do they say, well, we've seen enough, because the UK economy is seemingly slowing, and that should be on their minds. But I think the more dramatic question for central banks is really for the Bank of Japan, as every other central bank is raising rates quite a bit. And the Bank of Japan is still figuring out at what point it gets out of its yield curve control, and then gets to start raising interest rates. So the Bank of Japan is really far behind. The two big pressures, of course, on it are exchange rates, whether the Japanese yen plummets even more. And the second, of course, is the betting against their holding the yields at where they are in the markets, basically turning against the Bank of Japan and trying to push yields higher.
All right, I'm going to have to leave it there. Professor Raghuram Rajan there. He's a professor of finance at the Booth School over at the University of Chicago. He's also a former Bank of India governor, as well as serving a stint as the chief economist at the IMF. Scarlett?
All right, well, let's talk about FedEx, because amid all of this, FedEx did report earnings, and the company managing to handle the fallout, of course, of a costly labor fight this summer. Actually, that was UPS that did that. FedEx didn't have a labor issue, but we do want to bring in Bloomberg Intelligence senior analyst Lee Klaskow to give us a little bit more here. And I'm glad I brought up the labor issue, because certainly that provides a contrast to FedEx here. FedEx managing to post profit that topped estimates because of cost cuts. As Romaine pointed out earlier, this might be something that investors like in the short term, but it's not a long-term recipe for success, is it?
I would have to take the other side of that trade because I think what they're doing is FedEx for a long time is considered somewhat of a fat organization with a lot of bureaucracy, and that they're trying to thin down not only the corporate structure, but they're also trying to make their operations more efficient. So I think the cost cutting is not cutting to the bone. I think what they're doing is they're trying to create a more fluid network, a more efficient network, and a more profitable network long term. The issue with FedEx for the longest time has been on execution. I think what this quarter shows us is that they are executing on their plan. They have a plan to reduce costs by around $6 billion. You saw that in the earnings print. They beat expectations around 83 cents a share. And so that's, driving the stock up in the pre-market. They increased the low end of their guidance for the full year by 50 cents. I think that's, I think that's probably a little conservative given the 80-cent beat. Maybe they're just trying to be a little conservative, just given, where we don't know where the outlook's going to head from here.
Yeah, absolutely. Here, now the numbers look good, and we're looking at the after-hours trade. They're up 6% here, Lee. When we talk about some of the things that maybe aided not only what we saw in the most recent quarter, but what could aid them further here, I know they benefited to some degree by some of the concerns about the strike at UPS, which of course never actually happened, and then some concerns, of course, also about what happened with Yellow and whether some of that business actually ended up in FedEx's with FedEx.
Sure. So on the UPS side, yeah. So when the labor contracts were going on and there was a risk of strike, some shippers looked to divert freight away from UPS to FedEx. Now it's up to FedEx to see if they can win that business, if that business is going to be sticky. I would guess that some of it is not, but they probably could keep some of it. So that's net a good thing for market share. As it relates to their freight business, which is their less than truckload business, Yellow, which was at one time one of the largest LTL carriers out there, it went belly up. And that is an opportunity for them to win share. What I would say is not all of Yellow's freight is something that FedEx might want to carry because it's not necessarily profitable freight or good freight that an LTL carrier would like. They like palletized freight, stuff with typically that have low cargo claims. Yellow is known to have a lot of that non-palletized freight, and also they shipped a lot of glass and TVs and things like that. But definitely a market share opportunity for FedEx. So not only can they cut costs, but they do have some opportunities to win share in that business, that LTL business, which is called FedEx Freight.
All right, Lee, always smart, and thanks. You actually taught me a new phrase today, palletized freight. I wasn't familiar with that, but I understood it. Lee Klasko over at Bloomberg Intelligence. A look at FedEx. FedEx posting profit, the topping analyst estimates, and actually nudging up its forecast going forward. Those shares up 6% here in after-hours trading. As we wrap up our coverage here on this Wednesday afternoon, a push ahead to what the markets will have their eye on Thursday. That's coming up after the break. This is Bloomberg. A busy Wednesday, and of course, financial markets already looking forward to another big central bank decision tomorrow.
Yeah, Bank of England, 7 a.m.? They did get a CPI print today.
They did. Cooler than expected. You saw the odds shift around a little bit. We'll see if it actually changes the needle at all.
And we're going to come back to the U.S. and interview with James Bullard, formerly of the St. Louis Fed.
I've missed him. We don't hear enough from him.
Well, you're going to hear a lot from him tomorrow. We're also going to get some economic data, Scarlet, including jobless claims.
Yeah, high-frequency data, and of course, jobs of paramount concern for everyone following the Fed decision. There's also Philly Fed and existing home sales as well.
And on the political front here, the president is going to be meeting with the Ukrainian president, Volodymyr Zelensky, at the White House tomorrow. This has been fun, guys. You want to do it again?
Let's do it again.
All right.
Is there another Fed special coming up?
We're going to do a BOE Decides tomorrow. Stick around. Balance of Power is coming up next. This is Bloomberg.